All right, everybody, I'd like to introduce our next top-tier track presenter here at the Planet MicroCap Showcase 2024 in Las Vegas, hosted by Maj Soueidan from PureInvesting.com. He is doing a Q&A with James Lorimer from Data Communications Management. Take it away.
Oh, okay. Good.
Yeah.
Thanks, Robert. Pleasure to be here. I think this is our third year at Planet MicroCap in Vegas. First year, we had just listed on the OTCQX, kind of uplisting from the pink sheets, and we're pleased to announce that last year we were the fifth-ranked, kind of best 50 on the OTCQX based on share volume and appreciation. We had a pretty transformational acquisition that we actually talked a little bit about last year, and that was the acquisition of Moore Canada. I'll talk a little bit more about that as we get through. So we are listed on the TSX as well as on the OTCQX. Forward-looking statements here for everyone. We will be talking about some forward-looking information, and so just remind everyone to refer to our filing material, which is on SEDAR+, and in our MD&A and other statements on SEDAR+. Just kind of briefly, a little bit about who Data Communications Management Corp is. We've been around for about 65 years, founded in 1959. Head office is in Brampton. Our market cap's about $170 million on a fully diluted basis, about $185 million. All numbers are in Canadian dollars here. Richard Kellum, our president and CEO, had some conflicts and couldn't make it. I'm James Lorimer, the CFO, and I'll be presenting here. Really, at the heart of what we do is help our clients simplify complex marketing communications and operations workflows. So think about big, large enterprises that have not just tens, but often hundreds or thousands of branches or retail stores, and they have often, hundreds, if not thousands of employees, and often, typically, hundreds of thousands of clients. And how do they get printed material, digital material to them on a timely basis, make sure that it's accurate, make sure that it's personalized, and make sure that it evolves as their businesses evolve. And that's really kind of what we do. Last year, we reported revenue of about $470 million. That was up 63% compared to the prior year. A big part of that was because of the acquisition of Moore Canada we made. What really distinguishes our clients is long-term client contracts. More than 50% of our top 15 clients have been with us for more than 15 years. Many of our clients have been with us for 20, and we've even got a couple clients who have been with us for 50 years. So our clients are really sticky. We're really deeply embedded in their workflows. We have over 400 enterprise clients, 1,800 employees, and we have 20 sites across Canada and in the U.S. We have 13 kind of key manufacturing facilities today. By the end of this year, we're planning to consolidate 3 of those into our footprint, and so we'll end up at the end of this year with about 10 key manufacturing facilities right across Canada. Adjusted EBITDA last year was about $53 million. Again, up very nicely compared to the prior year, and really a big part of that because of the acquisition of Moore Canada. And we also generate significant levels of free cash flow. Really kind of what's at the heart of us, of our business, and while a lot of the market looks at us as a print company, and that's really kind of our core competency. We've got a lot of technology that underlies that, and that's what really differentiates us. When you're thinking about markets for personalized communications and business process outsourcing, and even kind of complex marketing solutions, we have a core platform we call DCM Flex, which is kind of our customer-facing platform, which allows our customers to go in and customize programs, marketing campaigns, distribution campaigns, and really kind of has embedded us in our clients' workflows. Core kind of big markets that we're active in would be financial services, retail. We're also active in the QSR, quick service kind of retail market, transportation and government agencies. We do a lot of work with both the airlines and the federal and provincial government in Canada. And then we're also big in the lottery market, so lottery tickets, lottery selection slips, we'd be kind of a dominant player in the Canadian market in that area. Some of the key trends that are really driving our business are kind of hyper-personalization. We've gone from, kind of one-to-many communication to very personalized kind of one-to-one communication. And that's really kind of at the core of what we do and what we think kind of differentiates our market focus. As you can imagine, working with big enterprises, really complex workflows, really complex communications, lots of regulatory and compliance things that need to be considered. And we kind of take that kind of pressure off our clients and make it really kind of, our tagline is surprisingly simple. Talk a little bit about Moore Canada. It was our largest competitor in the Canadian marketplace, owned by R.R. Donnelley previously, which is a large global print company. R.R. Donnelley had been taken private a few months, I guess about 2 years ago now. We approached them because we thought that the private equity group might have an interest in, kind of harvesting some cash to pay down debt, and we're successful in acquiring the business. We acquired it for about $100 million net of 3 real estate properties that came with it. We subsequently sold those properties off and generated cash to pay down some debt. So we paid about 4.5 times adjusted EBITDA for the business after adjusting for the real estate sales. We've got kind of four key things we're focused on this year. One is the integration of the Moore Canada business. Our public guidance is for $30 to $35 million of annualized synergies that we're going to derive from that business, and we're well advanced on that path. In our last quarterly press release, we advised that we're about halfway through kind of realizing those synergies. So a lot of the big synergy savings are going to come this year with the closure of the 3 kind of remaining plants. We're also focused on gross profit improvement. We're historically about a 30-31% gross margin business. The Moore business was 19 to 20%. Was really attractive to us because we think we can get those margins back up on a combined basis to north of 30%, and that's what we're really working hard on this year. We also think there's lots of opportunities to grow our business. The Canadian kind of traditional print business is about a $10 billion market. Combined, we're about 5% of that, and we'd be the second largest player. So there's a ton of room for not only stealing market share, but we think also growing that market that we have today. And of course, as we integrate facilities, the plan is to generate continued high levels of free cash flow. We're also active on the M&A front. We've got kind of 3 different pillars to our M&A strategy. One would be traditional print companies. Another area would be marketing services, so businesses that are complementary, maybe some down kind of vertical integration that can further leverage our physical print capacity, but also some of the technology solutions we have. And then we're also on the market for kind of small niche technology solutions that can add more value to our marketing technology platforms. From a capitalization perspective, currently shares trading around $3. We have about 55 million shares outstanding, 4.3 million options, some warrants from a private placement offering we did last year. So you can see market cap's about 185 million on a total enterprise value about 270 million. That includes about 85 million of kind of net debt. And we've got a very aggressive plan to pay down debt. Our target net debt to EBITDA is less than 1 times. Ownership, management is heavily invested as our board. Collectively between directors, officers, and employees and an employee share ownership plan, we hold almost 30% of the shares. We have a kind of an independent shareholder that's been a long time supporter of ours. I think KST Industries first invested about 11 years ago, and they've been very supportive through that period. In the private placement financing we did last year, we raised $26 million. About 80% of that was institutional, and as I understand it, most of those funds have not only kind of continued to hold our stock, but in a few cases have picked up some additional stock. So, broadly, the float is about 60%. I think a pretty good mix of, retail and high net worth and some MicroCap funds, as well as some good, mostly Canadian small cap, kind of blue chip type funds. Investment highlights, I'll kind of leave it here, and maybe Maj, if you want to kind of dig into a few things here, but we've got a very dominant position in the Canadian market. We look to continue to expand upon that. We really want to focus this year on profitable growth and really working on growing the margin in the Moore Canada business. And we're having some good success with that already. Over the next kind of 12 to 24 months, we think we can really move the dial on our margin. Continuing to pay down debt, focused really on generating those $30 to $35 million of synergies, which if we do that right, should help adjusted EBITDA grow, and looking to grow the top line organically, but also through acquisition. And with that, Maj, I guess over to you.
Thanks. Great. All right. We did this last year, so it's good to see you here again.
Yeah.
I am a shareholder in this DCM, and I want to touch on real quick. I know you did a pretty good job with the talking about your integration of the acquisition, Moore's. But were there any surprises during the positive or negative surprises during the integration that you kind of came away with?
Yeah, we were really well prepared for the integration and the deal. We hired Boston Consulting Group to advise us on kind of the operational due diligence, and through that, we really kind of planned out what we wanted to do with the business. We had a really good plan of attack, and we really hit the ground running kind of day one after the deal closed. So I'd say, the acquisition and integration is going certainly ahead of plan, and we did increase our synergy guidance. I guess a year ago when we announced the deal, we were talking about $25 to $30 million. We've since raised that to $30 to $35 million of total synergies. Fortunately, we haven't really found any warts or skeletons in the closet. We were well prepared. We found some great talent. We found some great salespeople, some great operations people. Great kind of people in all the other various functions. One of the real important things we did was literally day one, we had our combined sales teams in 5 offices right across the country. And we talked about kind of being one company, better together was the theme, and going from competitors to collaborators. You can imagine, for 50 years, we've been beating each other up in the market, and now we kind of had to come together and work closely. And I'd say that's one of the things that's really been a positive, is just the culture of kind of collaboration that we've been able to build. So
great. And I think you said you're consolidating from 14 to 10 facilities from Moore's, right? So was that what you had planned initially, or was that kind of you found that out during the integration that's what you could do?
Yeah, those were the 4 plants that we did identify through our planning, and we have historically pretty complementary products and services. Some new capabilities that they brought to the table that we didn't have, and vice versa, that we brought to the table for their client base. But the key thing was that there's an opportunity to really kind of consolidate overhead, take out cost of operations, labor, and really kind of fill our plants up. So yeah, these plants were all kind of planned from the beginning, and actually some of our original plans, we weren't going to close 2 of the plants until kind of mid-year 2025. We've brought those in towards the end of 2024.
Okay. And just like in the previous fireside chat here I had with Cameron and InTouch, they have a lot of exposure to retail, and brick and mortar type of companies. I'm wondering, from an industry point of view, what kind of pulse are you getting from your customers and the kind of economy we've been in? Are you seeing them push back at all? Is it harder to get them is the sales cycles getting longer, or are you seeing the demand just still kind of being where it should be?
Yeah, I'd say generally demand is still pretty steady. We've had a few programs that get pushed off or a few programs that kind of get pulled up and, into a prior period or pushed off into another period, but we're not seeing any kind of weakness really in the retail market. We're also pretty strong in the retail market now, combined if you think about kind of big box stores, but even, financial services has a lot of retail, QSR. We do a lot of work right across, kind of grocery, pharmacy, big box stores.
Right.
We've seen that market be on balance pretty healthy.
Okay. And something I wanted to just confirm too, Woodmore's, the client crossover, was there a lot of client crossover, or did you acquire a lot of new clients in that acquisition?
Yeah, good question. We did have a lot of crossover, but I'd say it was more concentrated within some of our larger accounts.
Okay.
Particularly probably in some of the financial services, some lottery accounts, and in the retail market. I think the stat was we had about by value, it was about 25% of our revenue kind of overlapped, but by total customer count, it was only about 12 or 15%. So we were able to capture a lot of new kind of enterprise clients, and now the value that we're able to bring is cross-selling some of our capabilities. A great example would be in the airline industry, where Moore was doing boarding passes and baggage tags. We didn't really do a lot of that, but we were doing loyalty programs, and so now we're able to kind of combine that with one client. Now we're doing the whole gamut from loyalty programs to kind of commercial print and baggage tags, and we're kind of figuring out strategies to, okay, now how do we go out and target other airlines with a complementary kind of offering? So.
All right, great. Something I noticed in your conference call, I think Richard was talking about some new initiatives that you're kind of going after. And maybe you can talk about some of those, other than what was in the conference call, maybe. But you talked about your digital signage business, which I thought was pretty interesting. And you're kind of crawling before you can, I guess, walk. You kind of said in the conference call. But that's interesting. I mean, it seems like a pretty cool kind of additional service. So maybe you could talk about what's going on there. But I would assume there's competition that you have to deal with there too, which is going to be interesting to hear how you're going to do that. It's a pretty competitive business, and there's certainly some established people and companies in that business. So are you? So just let's get into that a little bit.
Yeah. So the digital signage market is something that's really kind of new for us. We've been in the printed signage market for many years, and so if you think about any of the kind of physical printed signs you would see in a bank branch or in a store, either on the wall or outside in a billboard, and so maybe to an extent we've been maybe cannibalized by digital signage. So we found kind of an interesting offering that we've been working very closely with the vendor. We've had some really good reception kind of on an early basis into some clients, particularly in the retail sector. We've done a program in Ontario with the beer store, which is kind of the provincial regulatory outlet for where you can buy beer. It's not as open as it is here in Nevada, and they've done some pilot programs, gotten some very impressive kind of increases in sales based on some of the signage, and really kind of the kind of walk or crawl, walk, run strategy is we're not diving headlong into it. We're not spending a lot of money on it, but we've got a very dedicated kind of marketing plan around it and a sales plan around it, and really kind of leveraging with our clients kind of the broad suite of capabilities we can bring. Mm-hmm. And a lot of that is also in the kind of the marketing services. So it's not just you put up a digital sign, but then what do you do with it, and how do you maintain it, and how do you what is the content that you're going to put out in front of your clients? And that's where we think we have some kind of unique advantages that we can bring to the market.
Yeah. So your vendor supplies the hardware, basically.
Yeah.
And who does the install of everything? The vendor does that also?
Yeah, there's kind of a network of installers that we would contract, but it's also we can kind of bring some expertise in terms of We have a lot of, as we talked earlier about the retail business and strength that not only we had, but Moore had in the retail. We have some unique kind of what we call environmental design teams in our combined group that would do, store signage, store design, store layout, and, make sure that that's aligned with your brand and your philosophy. And so we're kind of bringing that whole package of capabilities.
Okay, and in terms of the economics of that business, are the margins going to be better or on par with what you're doing on?
Yeah, so surprisingly, the margins are pretty good in that, and the kind of traditional, if you're just a hardware reseller, the markets are not, the margins aren't great, but we've been able to generate decent margins. And then there's also some recurring revenue where we charge a fee per sign on a monthly basis. And that helps. That's really kind of the content generation and maintenance. So it's a smaller proportion than maybe the upfront sale, but it does have a nice kind of recurring revenue stream there as well.
So when you look at your customer base right now, I mean, would you say that most of them are not? Have you done any kind of polling as like how many are using or not using digital signing in their marketing yet?
Yeah, I think certainly a lot of retailers are using digital signage, and you go into a QSR store and you'll see menus are now digitally displayed. Sometimes there's promotional material at the counter, but I think we've got kind of a visually compelling platform that's a little bit different than that seems to be getting some traction. So it's small steps right now, but having some early progress.
Okay, great. And you talked about the personalized messaging in terms of marketing, and I thought that was one of the things I liked when we first came across. You had this new thing called personalized, or was it some?
Yeah, personal.
Yeah, personal, which is a kind of video, kind of personalized message type of thing. I want to know how that's been going. Is it getting the traction you wanted? Is it not? Where do you see that going?
Yeah, I'd say personal is a kind of a personalized video application that we've developed. We've historically been very strong in there's a big kind of technology market called CCM, or Customer Communications Management, and we've been very strong in that market from a direct mail. So think about personalized mail that you get at home. A lot of companies kind of went away from personalized mail with the internet and Amazon, and now we're seeing kind of a return to personalized mail, but with a big focus on generating higher response rates and tracking response rates. People are trying to get creative, and so it's kind of an omni-channel approach. So you're not just maybe delivering a physical printed product, but you're maybe sending an email, and then emails notoriously have a bad open rate. You think about all the junk mail you get in your own email every day. But if you can add video to that email to make it a little bit more engaging, personalize that video. So add some of the kind of personalized content that you could get previously in a direct mail. So great example we like to talk about is a credit card pre-authorized campaign. So it might say, Maj, you've been pre-approved for $50,000 with the new Amex card. And call your personal banker, and all those fields are personalized. So not only can we do that in a printed piece, we could do it in an email, and now we can do it in kind of a video email platform, and we're getting some positive reaction in that market. Yeah,
great. Yeah, and so you have these. I'm looking at some of the estimates out here, and you have 2024. We're looking at 34 cents, and then maybe in 2000, this is Canadian, in 2025, 84 cents. You're selling a pretty cheap valuation on 2025 for sure.
Yeah. Really, the focus is, as we integrate the businesses and deliver on those synergies, we should see a nice kind of bump in adjusted EBITDA, and we expect that 2025 should be a pretty clean year with the big changes that'll be completed at the end of this year. 2 big plant closures. We should get kind of the normalized run rate of that starting in the first quarter of 2025.
Great. And now, you gave some organic growth goals. I guess maybe for your legacy business, I think about 5% or so. And when you combine, do you think that's still going to be your goal going forward? And the combined company will be like a 5% kind of.
Yeah, we're still comfortable with a 5% kind of growth over the next 5 years. We have kind of revised that a little bit to say that, probably be a little bit slower in the first couple of years, but
Right.
accelerate in the back half,
Right.
to kind of average that. And really that's because we
And that's top line growth we're saying.
that's top line growth. Yeah. And the reason there is really our focus on kind of profitable growth. So some of the, as we kind of got under the covers, maybe to your earlier question about did we find any surprises, there were certainly some clients we found that were no margin, and so we're focused on either growing that margin or finding other clients to replace that client.
Okay. So I guess the investment case right now really is, in this next couple of years, really is integrating the acquisition and a lot of operating leverage, or a lot of leverage in general, just the leverage on the gross margin is going to be increasing. Then you're going to have operating leverage, I'm assuming, on the SG&A to really grow earnings. And then maybe in a couple of years, you resume some nice revenue growth too as we move forward.
Yeah.
As we're looking at. Again, any questions before I don't want to hog the time here, so we're running out. All right. So in terms of we talked about acquisitions. Would that be something you would do in the short term here, or would you want to wait till this kind of Morris train is kind of already going hard?
Yeah, we are continuing to look at acquisitions. We're not going to make a another transformative acquisition in the near term.
Right.
We've got our hands full over the next kind of 8 to 12 months.
Okay.
But yeah, we're certainly kind of looking every day at opportunities.
Great. All right, I think we're good.
Okay.
Anything else you need to add before we call it a day?
No, I think we covered a pretty
right.
good base there. Thanks, Mike.
All right, man. Thank you.